If you've been watching the enterprise software space lately, you've definitely seen Workiva's stock taking quite a beating. But here's the thing, is that battered stock finally a buy after their massive Q1 turnaround? Welcome to this explainer, where we're going to unpack the raw data, dig into the financial filings, and decode the analyst notes to figure out exactly what is going on with this company right now. Because with their first quarter 2026 results hitting the wire, it really looks like the narrative might be shifting. We're going to build a comprehensive, objective picture using only the hard facts to see if this is a hidden gem or just a falling knife.
Okay, let's dive into this. Here is our roadmap. First up, the Q1 turnaround. Second, we'll look at the customer moat. Third, valuation and price targets. And finally, navigating headwinds.
Section 1. The Q1 turnaround, growth meets profitability.
Honestly, the sheer velocity of this top-line growth is absolutely staggering. Workiva brought in $247.3 million in total revenue for the first quarter of 2026. Guys, that is a massive 20% year-over-year gain. And what's even more encouraging for the long-term health of the business is where that money's actually coming from. Subscription and support revenues alone hit $225.4 million. That's up 21% from last year. So this isn't just some one-off professional services driving a temporary spike, right? This is recurring subscription demand showing some incredible strength.
Now, before we get into profitability, let's just make sure we're all on the exact same page regarding non-GAAP operating margin. Basically, this metric represents a company's profit from its normal everyday operations, but it strips out all the unusual, one-time, or non-cash costs, things like stock-based compensation. We use this because it helps us see how well the company is actually performing in its day-to-day operations. It gives us the clearest possible picture of its true bottom-line potential, totally free from the noise of complex accounting distortions.
So, keeping that definition in mind, contrast these two figures. It's night and day. In the first quarter of 2025, Workiva's non-GAAP operating margin was a razor-thin 2.4%, barely breaking even. Fast forward exactly 1 year to Q1 2026, that margin has absolutely exploded to 18.4%. I mean, wow! This is literally the cornerstone of the turnaround thesis. Workiva didn't just grow their top-line revenue by 20%, they completely re-engineered their operational efficiency to deliver a dramatic shift toward real, tangible profitability. And they did it in just 4 quarters. Moving right along to Section 2, the customer moat, stickiness and growth.
And this brilliantly illustrates how Workiva actually keeps that revenue flowing. They boast an incredible 97% gross retention rate. This means they are keeping 97 cents of every single dollar from their existing customer base before any new upsells are even factored in. Their customers simply aren't leaving. But wait, it gets better. They also maintain a 112% net retention rate. This proves that not only do they keep the customers they have, but those exact same customers are actively spending more money over time, they're buying new solutions, they're accepting price hikes. Honestly, that is the literal definition of a sticky platform.
And that stickiness, it builds into compounding growth, especially for their largest contracts. As of March 2026, large enterprise adoption is surging. Customer spending over $100,000 annually grew by 24%. But look at the top tiers. This is wild. Customer spending over $300,000 grew by 38%. And those massive $500,000 counts surged by an incredible 39%. Jumping to 265 customers in that elite tier alone. They are successfully expanding their footprint deep inside the world's largest enterprises. All right, Section 3, valuation and price targets, spotting the discount. So when software companies start making that transition into real profitability, analysts love to use the price to sales, or PS ratio, to figure out value. Workiva's current PS ratio sits at 3.84 times sales. However, based on their specific growth profile and risk factors, quantitative analysis from Simply Wall Street suggests a fair value ratio of 4.56 times sales. When you contrast the current ratio with that benchmark, analysts are flagging the stock as technically undervalued right now. It's like the broader market hasn't fully digested the fundamental turnaround we were just talking about. And because of this disconnect, we are seeing some completely wild dueling narratives out there, with an incredibly wide gap in community fair value estimates. On one side, you've got cautious investors anchoring fair value way down at $79 per share. But on the exact opposite end of the spectrum, you have bullish investors who are laser-focused on that strong retention and expanding margin, pegging fair value all the way up at $280 per share. That massive delta? It just shows you how intensely debated Workiva's future is among retail and institutional investors alike right now.
But hey, we don't just have to sit around and guess what management thinks about this valuation gap, right? We can just look at their actions. Management has authorized a massive $350 million share repurchase program. And get this, they increased this authorization by $250 million in 2026 alone. They aren't just making empty promises either. In the first quarter, they aggressively scooped up 763,000 shares for $50 million. Management is looking at their balance sheet, seeing $863 million in cash and securities sitting there, and declaring loud and clear to the market that they believe their own stock is cheap.
Which brings us to a crucial pivot in part 4, navigating the headwinds, the bear case. Because we have to be objective here. What is actually causing that tiny 3% of customers who do leave to jump ship? Well, management noted that mergers and acquisitions, along with financial distress among their clients, unfortunately account for over half of their lost revenue. In a tough macroeconomic environment where companies are consolidating or just flat out going under, Workiva naturally loses those accounts. Plus, shifting regulations are throwing a pretty big wrench into their growth forecasts. To really understand that regulatory headwind, we just need to listen to exactly what management said. Quote, sales of our sustainability management solutions have been and may continue to be materially impacted by domestic and global policy uncertainties. See, Workiva invested heavily into their Workiva Carbon platform, betting big on a wave of global ESG reporting requirements. However, pushback, legal challenges to sustainability rules, and constantly shifting political priorities are actively stalling their market expansion in this specific area. Customers are basically pausing their buying decisions until all the legal dust settles. And let me tell you, Wall Street has absolutely taken notice of these roadblocks. These policy concerns and attrition risks have led major firms to slash their price targets recently. In early 2026, Stifel cut their target down to $65. BTIG maintained their rating but lowered their target to $80. And Baird dropped theirs to $86. These analysts are totally acknowledging the great quarter, but they are pricing in a severe discount because of all the uncertainty surrounding those crucial sustainability revenues and the broader economic environment. So what does this all mean for us? The ultimate question you've got to ask yourself right now is this: is the current valuation discount actually worth the regulatory risks? On one hand, you have a sticky, mission-critical software platform boasting a 20% revenue jump and explosive 18.4% operating margins, with management aggressively buying back their own stock. But on the other hand, you have stalling sustainability growth, macroeconomic attrition, and highly skeptical analysts slashing price targets left and right. Do you side with the fundamental turnaround, or do you respect the macro trends? That's the puzzle you need to weigh. Thanks so much for joining me on this explainer, and definitely keep digging into the data.